I wanted to give you all a local real estate lender perspective, kind of where the market is, et cetera.
So I'm Trevor Tolbert. I work at PNC Bank here in the DC area. I'm actually generally based out of our 17th Street PNC Place office. My focus here at PNC is large commercial transactions, primarily multifamily. There's a commercial component there oftentimes as well. But we're focused on the agency financing aspect of these projects. So Fannie, Freddie, HUD, real estate banking. I have additional focus in affordable housing, which is a pretty hot topic right now. So Fannie, Freddie, and HUD financing source. The bank loves that because it's not the bank's money, right? Essentially, it's easy to lend. It's really a revenue-based model for them. And again, it's multifamily. So it's, apartment buildings in these areas. What products we're working on right now, the first one would be HUD, which is FHA, which is a federal program. HUD offers refinance, acquisition, construction, perm, sub-rehab options. I guess the most popular question I hear is where are rates? Rates on these products range from about 5.5 to 6.5 for the construction perm product. HUD's 221D4 product is a construction perm, meaning they give you construction plus a 40-year fully amortizing perm product. That's the one that's at this, roughly 6.5, depending on the loan type or I guess size, location, affordability components that it may offer. And then they offer also a 223F program, which is the refi or acquisition program. This is a 35-year program, full amortization, so 35 with a typical 10-year prepay step down structure. So starts at 10%, goes down to 1%. This is, again, a market rate or affordable component, meaning if you have 5 or more units, typically we won't do anything less than 2 million. But 2 million to say 75, 100 million is the typical loan size for this program. It would fit in this. The component that we're looking for from the borrower is someone who has experience, generally local to their product. HUD likes to see people that know what they're doing. It's not their first rodeo. They have some liquidity, but HUD, in comparison to Fannie or Freddie, does not need as substantial of a client as they may need. So typically, net worth equal to loan amount, liquidity roughly 10%. Or 9 months of your debt service. And these deals are kind of slow moving. Anything with the federal government typically is. Probably 7 months to close a refi, which is long compared to some bank products out there. And for a new construction deal or sub-rehab deal, it would be about 12 months, depending on, again, the affordability component to the transaction. Fannie and Freddie, on the other hand, are much more versatile. They're a little more flexible. That said, they don't offer a construction loan. Typically, what we'll do is we can pair up a construction product at PNC off our balance sheet with a future takeout from one of these agencies, Fannie or Freddie, that is. Their loan proceeds, their loan programs vary drastically. There's an SBL, small balance loan program, that can go from about 1.2 million up to 7.5. And then there's the other programs that go from that 6.5, 7.5 $1 million range to whatever. We did a $90 million deal last year. While they don't offer construction programs or funds, they do offer firm forward programs. Fannie and Freddie offer refi programs as well. So that'll range from, I'm putting a deal at 540 today to 620 right now. Again, location, size, terms, a lot of different things go into this. They offer interest only. They offer a lot of different flexible options, but you really can't quote the exact rate until you get it in front of these agencies. Overall in the market, we're very busy, really, really, really busy right now, which is great to see. Last year was a down year due to the rates and that huge rate hikes, that took place over those, previous year. This year, things have been pretty stable. And I think that allows investors to figure out exactly, where they're going to be. That forward program between the Fannie, Freddie forwards are really what we're seeing a lot of, to be totally honest. The rates have come in, or at least have stabilized, and it's a great product. In comparatively, the Fannie program I mentioned is 5.2 million, or I'm sorry, 5.2%. The HUD program there is about 6.5%. right? The HUD program is a big headache. Fannie program, I can close in 75 days.
Oh, wow.
So, there's a lot more flexibility when working with Fannie or Freddie. I'm a MAP, which is HUD's underwriting license, holding, I guess, HUD guy, right? Like I love that product. I get the product, like the product, but when it doesn't make sense, you can't do it. So Fannie and Freddie is really the majority of our pipeline. HUD is kind of turning into a lender of last resorts again. So the forward is Fannie and Freddie's option of doing a forward commitment for the perm debt, right? So someone's going to give the construction loan. I did a deal with United out in Loudoun, right? I was the perm debt. So the Fannie product comes in at stabilization. United did the construction loan. So say it's 20 million in construction. My perm debt is 20 million. They do their construction. I take it out. So a lot of the smaller banks, at least from our experience, like that construction product because it's X over either SOFR or a treasury of some sort. It's a very nice profit center for them, but they don't want to do that long-term perm debt at low rates, right? And that's where the agencies come in. Their mandate is to do that or to provide housing. And a lot of times most apartments are affordable housing unless they're just luxury, right? Affordable housing is 60% and below AMI, which is area median income. And then typically workforce is 80% to 120%. Arlington, for example, I believe the AMI is about $130,000. So that's the average median income. Almost all housing is between 50% and 120% in Arlington. So it's almost all fits in that workforce or affordable bucket here. But yeah, so the forward program takes out that construction loan, but it also lets you, lock it in today, right? So we close the construction loan, we close the perm loan, essentially, and all you got to do is hit your numbers. And then you have your 6% interest rate 3 years from now, and that's when you start amortizing.
Old Dominion National Bank. I focus a lot on the residential construction side. So I'm looking at everything right now from single family teardowns in North Arlington. I got some small 30 lot subdivisions. I've got 20 unit apartment building construction loans. We're doing a little bit of the perm debt right now, but I'd say where I spend most of my time is on the construction side. I think what I'm seeing right now, like the single family stuff seems to continue to be clicking along and moving and trading at a reasonable price. I'm seeing the condos just continue to be slow in DC. They just don't seem to be moving as quickly as they have in years past. I mean, I'm not seeing like big value deterioration, but it just doesn't look like they're just not moving because the 7% mortgage that's horrible for all the first time home buyers. That's who it hits. It's not hitting the $3 million purchaser as much. I mean, the last 3 years has been a little bit interesting. Last year was it's odd to underwrite deals when your interest carry is doubled. So I feel like a lot of people are looking at deals differently than they did 24 months ago. It doesn't mean they don't work. We just have a new reality with rates, and that's kind of going back to what I said about if you locked in 2019, you're looking to refi, rates are going to be a little different. But there are definitely products out there that there are ways to get through before the rates start to come down, which maybe this year, maybe into next year.
Trevor, what do you think about rates? Everybody wants to know about that. I mean, I've seen most people predict there'll be 3 rate decreases this year, but maybe that's changing.
We still have 3 earliest June or July, I think is the thought, and they're going to be 325 bip decreases. I think that's still semi-priced in, right? I mean, the last week has been rough on rates, right? We went from 4.0. I was trying to rate lock a deal last week, do an index lock, so I can essentially do an early rate lock on my early rate lock. But it hit 399 last week, a 5-year treasury. We price most things over the treasury. It went from 399 to 435 today, I think, in a week. So there's volatility in there. I mean, those inflation numbers, PPI and CPI, weren't great. And I'm no economist. Don't listen to me for rate advice. I'd be making a lot more money doing something else if I knew. But I think they're going to come in. They're going to have to come in just because I think the election's going to play a role. And I think inflation has stabilized to essentially, it's a little bit hotter, but it wasn't a lot hotter. So we'll see where it goes. But I think they're coming in.
As 1031s are always interesting to me. People find them to be compelling to save money, but I've seen many situations, multiple situations where people 1031 in an asset they would never have bought for a price that was more than they probably would have paid to save money that then ends up backfiring. So,
And I think those 1031s have a deadline, like when you have to reallocate the funds, right? So HUD's
yeah,
sometimes a little bit of a slower option. You could do that into either of the agencies as well, Fannie or Freddie.
Yeah,
And
totally
again,
right.
the cash out transactions are even better, right? Because there's a little flexibility there. If I can only get you 15 instead of 16 million, you're probably not going to say no, you know?
Yeah, I tell you, the forward product is like massively compelling if you're a banker at a local bank. You know?
Yeah, I tell my guys that because I keep trying to tell my real estate banking group, you know, you guys should be lending on anything that we want to do a perm takeout on. It just makes sense. There's no risk to you.
Totally.
And
Oh,
it's
what's
just a
the
giant
risk?
revenue source. 350
Yeah.
over whatever you're lending on. I just put my email in there. But I mean, cool. And you got a essentially guaranteed takeout as long as someone hits their NOI. And I mean, even with cost overruns, everyone's hitting their NOI, right? 3 years from now, 2 years from
Yeah.
now, if your rents
Yeah.
aren't high enough to support the loan from today, then you did it wrong, honestly.
Yeah, totally. Definitely hit up Trevor and Rich if if you have things that you're looking at financing or you just want, their advice. I always say that like for me, I've given lots of free advice over time and to potential borrowers. And then I got to a point with some of them where I thought they'd never borrow from me and I was just giving them
Yep.
advice all the time. And then eventually they do, so it all kind of pays off in the end. I'm sure they'd be happy to give you advice and try to help you
Always.
as we all try to help each other.